First of all, I want to thank everyone for being here today because it's a beautiful Sunday afternoon, almost summer weather, and you guys have chosen to invest your time to be here with me and my team, so I'm very, very grateful for that. But you're investing your time to come and network with like-minded real estate investors, or to come and learn about real estate investing, or to come invest yourself. So for you guys to be here, I want to give you guys a round of applause. Please give yourself a round of applause. Let's go. This is big. I started investing in real estate 25 years ago, and I used to go in the back of a classified section in a newspaper, and I'd try to find free investor lunch and learns. That's where I got this whole lunch and learn from, 25 years ago, from the back of a newspaper. And I'd go on Sundays and I'd try to meet people and learn and do everything. So anyway, that's why we're here today. We're also here because we want to not only, identify a great market and a great opportunity, which we're going to talk about, but we want to talk about cutting through all of the noise, all of the headlines, where we don't know what to believe, everything's negative, TikTok, Instagram, all of that is giving a sentiment in the market which I think is very short-sighted. And we're here to talk about what's really happening in the market and what the future of the real estate market looks like. So, I'll ask you guys this. If you were to buy an investment property today at the bottom of the market, which I believe is the very bottom of the market, or would you have rather bought it 4 years ago at the peak of the market? And I think I know the answer is today at the bottom of the market. I'll also ask you this. Would you have rather bought a investment property today or 10 years ago? And I guarantee the answer was 10 years ago, because if you did buy a property, if you bought your home or an investment property, you are sitting on a mountain of cash right now because of that decision you made 10 years ago. And that's what we're really here to talk about. I'm here to talk about. Charles is the data guy. He's going to talk about the data. But I'm going to talk to you about investing and my philosophy and the strategies that I've applied to successfully investing over a long period of time, and that's a key part over a long period of time. So we're going to talk about the real estate multiplier effect and how to turn one property into 5 properties. I've turned my portfolio over a longer period of time into more than 5 properties, which I'll show you guys. But we've worked with hundreds of people. We've helped hundreds of our clients over 20 years. This is actually our 20th year in business, by the way. In July will be 20 years. So we've been doing this for a long time, and we're just really, really happy to have you guys here, and really great to see some old faces that I've known probably for 15 years now. So thank you. Before we jump in, our company Connect, my agents, if you could just put up your hand so everyone can identify who you are. These are all real estate owners, real estate investors. We've got an incredible team, and we do things a little differently. We take more of an investment advisor approach to real estate. Whether you're buying your dream home or you're a seller, we help you by kind of planning more for an investment part of real estate. We've helped homeowners tap into equity, so they've been able to pull out a home equity line of credit to be able to invest. We own a property management division where we help all of our clients, most of our clients, manage their properties. We have a team of accountants we work very closely with, helping our clients structure through corporate structures if needed, the proper structure anyway for scaling a portfolio. And we have great real estate agents, a team of mortgage brokers. Again, Aiden is here with National Bank. If you guys are having challenges getting financing in today's market, you need to go talk to Aiden, because National Bank is an A lender. I don't know what's going on. I think they're trying to grab market share right now, but they're helping our clients do financing that B lenders are turning away. So very, very good partnership with him. And we work with lawyers as well. Now, before I jump in, I just want to share my story with you, because real estate is such a significant part of my entire story, my life story. And this picture right here is, I was about 3 years old here, and that's my father and my mother and my sister. And these were the first properties that my mom and my father owned. And tragically, about 6 months after this photo was taken, I lost my father in a work accident. And the reason why I share this story is because real estate has been such an integral part of my entire life. Through the first generation, I'm passing it on to the next generation. And I wouldn't have had the upbringing, the life that I was provided by my mother, who was a single parent, never remarried. She was a school teacher on a single income, and what she was able to provide for my family through real estate as a means to help provide it was truly remarkable. I remember at the age of probably 3 or 4, in the back seat of her car, she'd be driving around every month picking up rent checks And I didn't know they were rent checks, picking up checks and cash from strangers. And I couldn't understand what was happening every month. And then all of a sudden I found out as I got older, those were in fact her tenants, and they were helping her pay off her mortgage. And for me, that really stuck at a really, really young age. And for me, that's where it all began. For me, it all started with the help of my mom and the first home, my first home. And that property, that dilapidated bungalow in Brantford, Ontario, my mom bought for, I think, $11,000 or something crazy. She ended up selling it about 24 years ago and bought my sister and I a condo in this building downtown Toronto. It was a 1,000 square foot, 2-bedroom condo where my mom sold it. I wish she had refinanced it, but she sold the property and she bought us this incredible condo. And that planted the seed for the real estate portfolio that I'm going to share with you guys today. About 3 or 4 years after my mom bought that, my sister got married, moved back to Brantford, bought her family home, also bought a pre-construction condo. I bought a home in Leslieville. I bought a pre-construction condo, and the rest is history. So let's jump right in. So the investor operating system, the iOS, these are the strategies, the basic principles to simplify what I've learned over the last 25 years. It's a step-by-step system for creating serious wealth through real estate, and it's made up of 4 pillars. The first one is the power of leverage. I'm going to skip the quotes just to kind of get through this presentation. Charles has got a good one for us. So what is leverage? And it's often referred to as OPM, other people's money. It's when you're taking the bank's money, for example, to go buy a property, and then you're going over here and getting a stranger, a tenant, to go pay the bank back, right? Real estate allows for the most leverage. I mean, sometimes higher than 80%, but you typically 80% of an investment, you can go to a bank and you could get through leverage. And it's the cheapest leverage. Now that's really important because you can't go with a business or a stock portfolio, walk into a bank and ask for leverage. It's very, very difficult. It's very expensive. But a bank is happy to lend. If the property makes sense and the person makes sense, they will lend over and over and over because they love real estate. The miracle of compound interest, well, it's often referred to as the snowball effect. So it's earning interest on your initial investment and then earning interest on interest on interest on interest. And over a long period of time, this is truly the compounding, the leverage, which is what builds serious wealth. And just to give you guys an example of what that looks like, a $100,000 investment made in the TSX in 2004, by the end of 2024 would be worth approximately $275,000, which is 175% return on investment. Not bad, right? That same investment in 2004 used as leverage, a 20% down payment on the average home price in 2024 would be worth $1.687 million today, or a 1,500% return on investment. So the TSX has done really well, but you would not have been able to get leverage. Real estate's outperformed the TSX, to be honest, but once you factor the leverage, you're getting almost a 5x return, which you just don't get on other assets. Now, how to generate passive income. I remember my grandfather at the youngest of age, I was probably 4 or 5, he said, Ryan, if you can earn money while you sleep, you'll do very well in life. And then he said, if you can learn how to do that multiple times, the multiple streams of income, you're going to do very well in life. And for me, real estate obviously was ingrained into me at a very early age, but it became the easiest and most obvious way for me to be able to create multiple streams of income. It's, when you're sleeping, there's rent currently coming in. If you're vacationing, rent's currently coming in. And let's be honest, it's very important. A lot of people leave one job to go invest into real estate, become full-time investors. I don't believe that's what it's about for most people. It's about creating financial freedom. So it's very important to have that passive part of it. And then the time value of money. This is the very important piece. And this is what I kind of alluded to at the beginning of my opening, is if you invested 5 years ago, depending on the market, you might not be looking like you made a good decision. But if you had invested 10 years ago, you'd be laughing. You'd have a lot of equity. You'd feel really good about your investment. So I ask you, what does the next 5 years look like? And that's what Charles is going to do really well for us today. Just to highlight the time value of money, this is a chart here from the Toronto Real Estate Board for the last 47 years. Lots of ups, lots of downs, lots of flatness. The market has appreciated, compounded 6.27% per year. And that's including the last 3, 4, 5 years of losses, depending where you are. sorry, let me go back there. And just to put the leverage and compounding into perspective, if you were to buy the average home price at $64,000 in 1977, and you put down 20%, which is $12,000, your investment would have turned into $1.1 million today. And you guys may say that's crazy, that's 47 years, but I heard it last week. Actually, it was on Friday when we were at an event. He was talking about buying a house for $21,000 in 1961. And that same house now is worth close to $2 million. So we all know someone who's talks about the house that them or their grandfather or someone bought many years ago. Now we're going to talk about how to turn that one property and turn it into a 5. So essentially it's taking the principles, the pillars of the iOS and applying it to a real estate portfolio. And that's made up of investing, renting, refinancing, and repeating. And that's when you see those 4 pillars really help push a portfolio. What do I mean by that? So equity in your property isn't working for you if it's just sitting there. Now, today might not be the right market to pull equity out because interest rates may be too high, but this is part of the tactic when you use in the right market. Some people may say now is a great time because real estate prices are so distressed right now that now is a good time to take out market and buy, take out money and buy real estate. So depending how you look at it, but the reality is most people don't know that they can use the equity in their home or their investment properties through a refinance or a home equity line to be able to invest into more real estate. Now, it's way easier to turn equity into cash flow versus slowly investing for cash flow. So what do I mean by that? A lot of people focus on investing in markets that are cash flow friendly or cash flow positive. Very, very important. But if you're focusing on a market that doesn't have the fundamentals where there's infrastructure, transit, schools, population growth, job growth, you're not going to see capital appreciation. I'll tell you, cash flow alone will not make you rich. Equity and appreciation is what's going to make you rich. So it's very important when you guys are investing, whether it's with us or who you're investing with, is that you're focusing on the fundamentals, which is job growth, population growth, transit, infrastructure, all of the things that Charles is actually going to talk about happening in Pickering, which we're really excited about. So refinancing, it's also the best tax avoidance strategy to ever exist. And it's tax deductible. So what do I mean by that? If I were to sell a property today, I'd be hit with a capital gains tax and I'd be left in my pocket to go reinvest with X amount of dollars. If I took that same property and I refinanced it and I didn't pay tax because I'm deferring the tax until I pay, I'd be left with relatively around the same amount of money in my pocket to go reinvest, but I'd still own the first property. And it becomes a tax deduction. So I'll show you guys a real life example of that shortly. But that's very, very, very powerful. Actually, this is the example right here. So this is a property that I bought in 2017 for $602,000. Now, I had this refinanced about 2 years ago. I haven't done much refinancing the last 2 years. Obviously, with the market, the rates, hasn't made a lot of sense. I have actually put a home equity line on my home, and I have used that to go buy more real estate, because I do believe there's opportunities in this market that we haven't seen before. But for this example, this is the last refinance I did 2 years ago. At that time, the property was appraised at $1.175. Today, it's closer to $1 million because it's gone down, and the current rent is still $3,900 per month. So at that time, I got 80% of the appraised amount, which was $940,000. I had to pay off my existing mortgage, which left me with $457,000 tax-deferred money. I'm paying no tax on that money. So what did I do with that? I mean, the property became very cash flow negative. I took about $280,000. I bought 3 more properties, and then I left the rest in this bank account to cover the shortfall. So now I have a negative return on my tax return every year. I've got the money to cover it, and I've gone and I've doubled down. I bought other properties. And this is just an example of tying it all together over a period of time with multiple properties. So, if you were to buy a property today at $710,000, here, property 1, you'd put down 20%, which is $140,000. Now, if you take the 6.27% compounded return over the last 47 years, in 6 years, you would have enough equity to buy property number 2 without putting any more money into the property. You'd have some excess cash, $68,000, to put into property number 3, which means you'd put in an additional $124,000. So in this scenario, if you want to kind of speed up your long-term goals, you buy property 1 in year 1, you buy property 2 and 3 in year 6, and at this point, you have about $270,000 in. Let's call it $300,000, $350,000 with closing costs. In year 12, if all things remain the same, you're going to have enough equity to refinance property 1, 2, and 3 and buy property 4, 5, and 6. So you're not going to be putting any new money into the deal at that point. And to highlight what that looks like over time, in year 1, your portfolio is worth $710,000. Year 6, it's $2.8 million, but you only have $557,000 in equity. In year 12, this is when it starts to get pretty interesting. Your portfolio is worth $8.3, but you only have $1.6 million in equity. And this is where it gets really interesting. And this is the time value of money and why it's so important to be in this for the long term. Because I guarantee there's ups and downs in this 25-year period. Portfolio is worth $18 million, and you've gained, in this scenario, $14 million in equity. Sorry? It
says somewhere REFI or something.
REFI, refinance.
Oh, okay.
Yeah, sorry, refi.
Which market would this be?
So this is taking the 47-year average, 6.27% annualized, and I'm forecasting based on 47 years of...
GTA?
Yeah, GTA. Yeah, GTA.
Okay, thanks.
Yeah, thank you. And to show you guys, to highlight a real-life portfolio, this is my portfolio right here, and I like to always say it's time in the market, it's not timing the market. And this is a real-life, multi-generational wealth real estate portfolio. You know, my mom helped me with that first property 25 years ago, and I've been able to take that property over time. And obviously, I've had a very good run with a few ups and downs. But the fact that I've been doing it consistently over 25 years and not selling is what's allowed me to accumulate a portfolio like this. Now, to show you what that looks like, that's about a $36 million portfolio today. I have a tremendous amount of debt on it, so I'm not worth $36 million, but this is where it gets interesting. If I did nothing today and the market just went up 4% for the next 20 years, I did absolutely nothing, that portfolio would turn into $79 million in 20 years. It'd probably be paid off or close to paid off by that point. And then in 25 years, 30 years, when you start compounding, it gets really interesting. I went to 120 years, it's $4 billion. The only reason why I did that, I was in France last summer, and everyone has a $100 million yacht. And I started thinking about it. They are so multi-generational in Europe. If you go to any major city in Europe, there's $100 million yachts everywhere. It's no thing. Canada's a very young country. This is a second generation real estate portfolio. This will be passed on to my children, and this will survive for 120 years because I'm setting up through a trust structure, and I'll do it in a way that protects the real estate but pays out. So it's actually it's a funny but real life type scenario. And then if we take the average, which is actually down since I updated this chart last year. So last year with the markets down, you know, obviously the average used to be 6.43% over 45 years. So if I take that average, and in 20 years doing nothing, so if I take the historical numbers, which most people do to forecast, my portfolio in 20 years would be $126 million. And that's with doing nothing. That's just letting it appreciate.
Ryan, how many of these properties are negative cash flowing versus positive cash flowing?
Yeah, good question. I mean, I've been doing it long enough that a lot are I've got a mix of both. So that example that I'll show you, I'll go back to quickly. Anytime I've refinanced, I've kept cash in the account, so it'll cover the shortfall. I kept about $150,000 in this account, so it can cover the next 10 years of negative cash flow if that's the case.
And that is still tax-free, you claim?
Oh yeah, that's a tax loss, yeah, for sure.
Is your accountant here?
No. but come and talk to me after, I'll give you his contact.
Because I'm getting conflicting answers on.
Well, come talk to me after. I've been doing this a very long time, and I'm doing it by the book. But I have heard there are conflicting things, and trust me, it's
Ryan, can I ask please, what is the difference difference between refinancing and home equity line of credit?
It's very similar.
Which one is the best to use?
It really depends on the situation. So a home equity line, you don't pay interest until you take the money out. So if you go, I got one on my house right now for $1.5 million. I haven't taken any money out, so it's sitting there. As soon as I take $1 million out, I've already done it. It's sitting there. And I could use it whenever I want. So it gives you a lot of flexibility. It's typically always only interest only. Sometimes you could get a kind of a blended principal interest, but that guy back there, he'll tell you how to do it exactly. But yeah, it depends on the situation scenario, and happy to chat.
And for the refinancing, you're going to start to pay interest right away.
It's a brand new mortgage. You pay right away, and it's interest and principal.
Thank you.
You're welcome. By the way, we may have the youngest real estate investor here. I love it.
This is the future.
I love it. It's awesome. So why pre-construction condos? Now, pre-construction has obviously had a bad rap over the last few years. And again, I plead for you to look at the long-term growth of pre-construction. But for me, it's always been about the passiveness. I would never have been able to scale a portfolio that I have today. It's very hands-off. You're getting leverage essentially. So, it's an easy hands-off way of creating wealth. You're investing without a mortgage. So that's why most people like it. You don't have to figure out a mortgage now. You figure it out in 4, 5, 6 years. And that allows your property to appreciate so that when you get a mortgage, it's typically easier to do so. It's the ultimate leverage. You're borrowing without a mortgage. Again, you're not paying an interest rate. So you're getting, if you're buying a 5, 10, 15% down deal from a developer, you're getting free leverage essentially because you're getting the appreciation of the full asset without having to take out a mortgage and pay against it. It's passive. It's as easy as owning a mutual fund. It's a scalable way, as I've said, the way I've done it with my portfolio, to create multiple streams of income. And the time equals money. It reduces risk, and it really, it's less liquid, but it's less risk. So I go full circle to where I began. This is my mom over here. She gave me literally everything. Real estate was a big part of that story. This is a trip. I took her to her birthday, her 70th birthday to the Vatican. She's very Catholic, and she just loved it. So I took my whole family, and this is my family here. I've got a 13-month-old at home now and a 9-year-old daughter. And I'm just so happy to be able to pass on what I've created, what my family's helped me create to the next generation. So at that, I'm going to wrap things up. And Charles, if you can take it away with some data, please.
Happy to.
Thank you.
Let's give Ryan a round of applause.
Thanks, guys. Thank you. Thanks, man.
Pleasure. Thank you. It's not every day you get to hear from such an accomplished real estate investor that's done so well, like Ryan and some of the members of his team. My name is Charles. I own a consulting firm. We work with builders around the city. This past year, we had 20% market share of all the high-rise condominium transactions in the city, and we're consumer market experts. So what I'll start with is, the first slide here is just going to tell you a little bit about 1515 Pickering Parkway, who the group is behind this project. After that, I'm going to go into what's happening in the market. And then we'll circle back after talking about the market to 1515 Pickering Parkway again. So Sevoy Development is part of the Fieldgate Homes family. So this is a large Canadian real estate company, one of the biggest. They've built over 35,000 homes, and they're the biggest landowners in Durham. To the point where even if you don't see the Fieldgate Homes sign, they're often the land owners and the silent partners in the deals on homes. And they've done many large-scale high-rise projects. These 4 are only the 4 that I've helped them with and that my team has helped them with. North Core at Yonge and Sheppard, the 1200 in Trinity Bellwoods, the Poet in Leslieville, and the Heartwood in the Beaches. And then you can see they have a large pipeline of more high-rise development sites throughout the GTA, and this was the next one on the list. And we chose to bring this one to market for very strategic reasons, because we could have brought in another Yonge and Sheppard, Mimico GO train station, Vaughan, different locations to market, but strategically we chose 1515, and I'll get into why. let's talk about a couple of real estate, high-level real estate fundamentals here. So this is a rule of thumb that we use, months of inventory. And this shows months of inventory data going back to 2014, so 11 years. And this is for all Toronto Real Estate Board transactions, so low-rise and high-rise. And what you'll see is that months of inventory is now trending around 5 or 6. And in a really hot market, a really hot seller's market, where we had such a housing shortage, months of inventory is typically below 3, right? So when months of inventory is below 3, we're in a hot seller's market. And with COVID, as you can see, it spiked up to 6, but then immediately came down again with interest rates, right? Because the Bank of Canada lowered interest rates, despite us being in a once-in-a-century pandemic and having so much uncertainty. So interest rates was the most important factor here. And then you can see we've sort of steadily climbed in terms of months of inventory here. The other rule of thumb I want to point out is the new sales to listing ratio, right? So this is sellers versus buyer market. Again, before the pandemic, we were typically above a 50% sales to listing ratio. After the pandemic, typically below a 50% sales to listing ratio. So we're technically in a buyer's market. What's interesting in a buyer's market is that the buyers aren't buying. There's not as much transactions happening. So the buyers that are transacting have more power to negotiate. And the sellers are willing to offer better deals, right? So that's where you can find opportunities. Not everything's an opportunity, but you can find the right opportunities in a buyer's market. So here's another look at months of inventory. And we're focusing first on last September to this past March. And now we've split it between high-rise and freehold. High-rise is in green on top, freehold's in black here. So we are a high-rise city, right? We are the condo capital of North America and maybe the world. And so we just generally have more high-rise supply, right? As you can see, months of inventory for condo is higher just because we have more supply for it. By the way, the way you calculate months of inventory is the number of transactions that month based on all inventory that's available on the market. So if the transactions on a monthly basis go up, let's say the next month transactions go up and the amount of inventory stays stable, then your months of inventory comes down because the number of months it would take to use up all that inventory would come down. So just because we're at 6 months of inventory doesn't mean it would necessarily take 6 months for all the inventory to get used because it's a static snapshot at a point in time, right, on a monthly basis. What it means is if the sales stayed at the same pace and the inventory didn't grow, it would take 6 months. But sales can pick up or sales can slow down. So that's a quick months of inventory rundown. What I'd like to point out is last September was one of the softest years of 2024. And by this time, we had already had 3 rate drops from the Bank of Canada, but they were 25 basis point drops. And they started right before the summer and during the summer. Then in October, if you'll remember, we had the jumbo rate cut. Do you remember that? The 50 basis points drop. And that happened on October 23rd. And everybody generally knew it was coming. The media was publishing that we were getting a jumbo rate cut. All the analysts were saying it was a sure thing. So the market reacted by increasing the transaction volume. So you can actually see months of inventory coming down. The interesting thing is we didn't see months of inventory come down with 25 basis point rate cuts from the Bank of Canada, but we do see it with the 50 basis point drop. And then on December 11th, we had our second consecutive 50 basis point drop. So the Bank of Canada's rate came down by a full 1% with 2 back-to-back announcements. So then we see months of inventory climbing back up again. Why is this? Well, you can see it's over the holidays, right? People are going away, the weather is worse, not focused on transacting in real estate, and because of all the increase in transactions, more sellers started listing their properties on the market. So the inventory climbed and went up. And then as we started to enter the spring market, it went down again, but slowly climbed again. So this is from that holiday period, and you can see how months of inventory came back down and then slowly started to climb again. Well, why is it climbing again? Because we haven't had another 50 basis point drop. It's only been incremental 25 basis point drops, and the past 2 announcements have been holds. So this is a slide here that shows pre-construction high-rise transactions in dark blue related to the y-axis on the left, and I'll summarize it because I know a lot of you probably can't see exactly what's happening on the chart. And then in light blue here is Ontario population growth on an annual basis. This goes back to 2013, and you can see it's related to this axis here on this side. Okay, so the Toronto pre-construction condo market in terms of volume of transactions is one of the largest in the world, comparable to Shenzhen, Shanghai, Mumbai, bigger than New York City by far, the biggest by far in North America. You know, Miami has a pre-construction condo market. You can invest pre-construction off of a floor plan if you put a large deposit, 40% deposit. But the peak year in Miami is 3,500 pre-construction condo sales. Peak years in Toronto are 35,000 pre-construction condo sales. So we have a big housing market in terms of housing output, but it's also predominantly high-rise. We are a high-rise city. We currently have 300 cranes. We used to have 400, right? New York has 10 cranes. Chicago has 40 cranes, right? The US produces a lot of housing. There's other cities in the US that produce the same or a little bit more housing, but it's mostly low-rise, okay? We are a high-rise city. That's unique. And the way the high-rise gets built is pre-construction. So once the buildings are 80% sold, that's when it gets built. In the US, the high-rises are typically, like a high-rise in LA, once they're built, then they start selling. Once the roof is up, then they start selling. That's how it typically works. So the opportunity for investors for pre-construction is here, right? Because you get in and then you have the 4 years of, as Ryan would say, free leverage, essentially, before the building gets delivered. So an interesting point here is the turning point, the inflection here between population growth and the pre-construction transactions. Because with no transactions, there's no future construction supply, right? Because it all depends on the pre-sales. So Ontario is growing on average between 100 to 200,000 people every year, up until the pandemic where they closed the doors. And then because they closed the doors, in order to make up for it, they tripled population growth, up to 500,000 people per year. So you have population growth going up. Meanwhile, you have new condo supply, the majority of our housing going down. So this is going to create a big problem once the interest rates settle. A big housing shortage. Now, Ryan talked about price appreciation. You were saying 6%, right?
Yeah, 6.27.
6.27. Okay, so 6.2 for condos, as you can see here as well. Going back to 2015, I don't know when you started looking, but
I took the overall all property types for the GTA, 47 years.
So we've got like the same numbers essentially. So going back to 2015, if you owned a second-hand condo on the resale market in 2015, and then you compared it against today, it's gone up by 6.2%, and per year, 6.2% per year. Overall, it's gone up by 83%. And if you factor in the leverage, the fact that you put in, the only cash you put out was the down payment, essentially, the return on that down payment is over 400%, right? So generally speaking, people that have owned real estate in Toronto have built a tremendous amount of wealth, right? Because there's a lot of demand for Toronto. And the demand far outpaces the supply of housing. So you also see townhomes here, semi-detached and detached. So it's an interesting chart because you can see sort of the breakdown in the appreciation here. I'll handle questions at the end, okay? But in terms of fastest growing cities in North America, you'll see Toronto is here at the top of the list, right? Toronto is popular because it's easier to get into than the US. We have a good passport and it's stable. We have a really diverse economy. Most multicultural city in the world, so people from all over the world, when there's instability back home, they can come here, blend right in, bring their family, go to the local market. You know, their mother who doesn't speak any English can walk into the market. She feels like she's back home, right? That's the beauty of Toronto, and there's no hurricanes and forest fires and, you know, earthquakes. You have stability. We're not New York, right? People say Toronto is not New York, because people talk about, well, will Toronto pricing ever get to New York pricing, right? Well, Toronto's not New York. No, it's not. But it is more multicultural than New York. We are the second largest financial sector in North America next to New York, right? It's pretty good. fastest growing tech market in North America. So this is an amazing place to own real estate in. And the federal government's immigration into the country, in 2015, it was averaging, from 2015 to 2019, it was averaging 440,000 people into the country. From 2020 to 2024, because of the drop, again, due to us closing the doors with COVID in immigration, and making up for that by allowing so many more people to come into the country, we averaged 730,000 people into the country every year, including non-permanent residents. And in June of 2024, so this was before Carney came in, this was the projection. Projection was for the next 2 years, 2025 and 2026, we would be flat in terms of our population growth. But every year afterwards, we would be at 400,000 people per year or 500,000 people per year, which would mean we would average 350,000 people into the country between now and 2031. When you have 350,000 people coming into the country, 40% of those move to Ontario, and 77% of those move to the GTA. That's about 150,000 people moving into the GTA every year. Now Carney has come in, and I'll speak about his immigration policy, because I think this is important. And when the current federal government talks about immigration, they're talking about it in relation to the housing market, as part of a solution to the housing market. But what you'll see is that we're actually going to be going back to this level of immigration here, which is very high amounts. The other thing I think we should note here is the quality of the people that are coming in. The criteria of permanent residence, 58% are economic immigrants, which means that they're coming in with more education, money, they're contributing to the economy. That's why they're being chosen to come into the country. 22% are family sponsored, so they're bringing immediate family over from back home. And then 20% is humanitarian or other, right? Refugee. And of course, they all need places to live too. But it's really the 58% and maybe the 22% that are bidding up housing pricing, right? Because they're coming in with money. So we looked at the pre-construction condo transactions before. This is the completions. So the green that you see here, going back to 2010, shows the amount of completed condos on an annual basis, right? So we've got, this black line represents 15,000 completed condos every year, right? So you can see in 2014, we had almost 25,000 completed condos. 2022 was less, just under 15,000. Now for 2024, the projections were that we were going to have over 35,000 completed condos. But we ended up having just under 30 because there's capacity issues in terms of trade and work. 2025, you can see, was over 35,000 in terms of the projection, but this is what's under construction. So chances are we're going to have the capacity issues. We're going to settle in under 30,000 again, okay, in terms of completions. This is important because we're talking about the supply side right now, right? So people say, like, the market is being flooded with inventory. Is it really being flooded right now? I mean, 2014, we had just under 25,000 completions. 2024, we've got just over 25,000 completions. If we were in a low interest rate environment right now, this supply wouldn't matter. It would be a drop in the bucket because we're still talking about 150,000 people coming in to the GTA, right? But it's the interest rates that's slowing it down. But here's where it really gets interesting. When you start projecting out in terms of what's under construction, and forget what's not under construction. Because if it's not under construction, it's maybe 10, 20, 30, 40% sold. It's not going to be built in 2026 or 2027. So these numbers don't really mean anything. What you want to look at is what we have here in red. So in 2027, it looks like we're going to have about 6,000 completions. Maybe it's 7,000, maybe it's 8,000. In any case, you have 150,000 people moving in, and there's 8,000 new condos being completed in the GTA. And this is the predominant form of housing. This represents 60 to 80% of all new housing in the GTA is high-rise because we're a high-rise city. So if we thought that we had a housing shortage before, it's nothing compared to the housing shortage that we're going to see in 2027 and 2028 and 2029. And if you own real estate here, so if you're currently going through closings and occupancies right now, it's a tough time. The interim occupancy fees are higher, the interest rates are higher. It's going to be a really good time to own real estate in 27, 28, 29. You're going to be in a very strong position as a seller or as a landlord. So let's talk now about interest rates. This is the trend curve of interest rates right before the pandemic, right after the pandemic, and then projecting what will happen before the interest rates started to drop. So this was a snapshot as of January of 2024, before the Bank of Canada started lowering the interest rates. And it's interesting because we can see the bank's projections, what they were all projecting, and we can actually look back now and see how they did on their forecasts. So before the pandemic, the rates were just under 2%. The pandemic happens and it's an emergency. Everything is shutting down, and the Bank of Canada and central banks around the world need to do something to keep the economies alive. So they drop interest rates down very low. This is essentially like free money, because if you're taking a loan, a mortgage, the interest rate is very, very cheap. The central banks kept the interest rates low for so long that the economy ran hot. The prices of goods were going up. Clothing, cars, jewelry, watches, right? Everything was going up. And they decided that that was now a problem. And they probably should have started increasing interest rates more gradually sooner. And so you heard Tiff Macklem, the governor of Bank of Canada, start to talk about a soft landing. We want to have a soft landing. And what they're talking about doing is increasing joblessness, hurting the economy by increasing interest rates, but not breaking the economy, right? Not going into a recession. We want the soft landing. So this is where the increases started, right? In early 2022. And so how did they do? So TD, Scotiabank, CIBC, BMO, RBC, how did they do with their forecasts? Well, looking back to this past March, they were essentially all forecasting that the Bank of Canada would be at 3%, which we were. So up until this past March, they were pretty much right on point with exactly what happened. Now we're at 2.75%, and the curveball that's come in is the tariffs, which has added a lot of uncertainty. And if you're reading the reports from the Bank of Canada and you're listening to the speeches that Tiff Macklem is making, his entire focus, the Bank of Canada's entire focus right now, is on the uncertainty around the tariffs. I'm going to speak about that as well. So as of March 3rd, this is the bank's updated projections. And Scotiabank has actually since updated their forecast to say that the rates will go down to 2%, because they're sort of the most conservative here, saying that the rates will stay at 2.75. But they're saying that it's probably going to happen early next year. So, but what you'll see, the consensus here is essentially 2.25%. And with Scotia's updated forecast, 2%. But again, this is before the tariffs, right? This is the Bank of Canada's interest rate, the central bank rate, right? So the central bank rate, bank prime rate, floats on top of that, right? And that's where you get your, that's where you get your variable rate mortgages, as Aidan will tell you, right? But look, like if we're at 2% in terms of our Bank of Canada inflation rate, it's basically, our Bank of Canada interest rate is basically where we were in 2019, 2018. That's a really low, healthy rate. The fact is that even now at 2.75%, it's a low rate. But the people, as I'll show you soon, the demand doesn't come back into the market until the rates have completely settled. I'll get to that in a minute. This is the past interest rate announcements, June, July, September, October. These were the two jumbo rate cuts that we mentioned. These are the upcoming ones. So these past two were holds. July 30th is our next announcement date. So analysts are calling that this will be a 25 basis point drop in July now. The analysts all sort of predicted that June was going to be a hold and April was going to be a hold. So when they held the rates, it wasn't really a surprise for the markets. So this is a really interesting chart. So this goes back to 2005. So now we're looking at bank prime rate. So the rate that floats on top of the Bank of Canada rate, right? And I'll just walk you through this here. In blue, you see percentage year-over-year change in sales for all Toronto real estate boards and all Toronto real estate board zones, geographic areas, and property types. Okay, so you can see percentage change, and that's on this axis here. So you can see it goes all the way up to 100% on this side, right? And down to 40, 50% on this side. So let's look at what happened with the 2008 financial crisis. This is the global financial crisis, right? Banks were getting bailed out. And so the rates came down, right? Central banks around the world dropped rates. This is the Canadian bank prime rate that was coming down. What you'll notice that's interesting is as the rates were coming down, just as they are now with us, the sales volume didn't go up as the rates were coming down. The sales volume went up once they were done coming down. When the rates go up, sales come down right away, right? This is in 2010. Sales are going down by 30% when the rates go up. Rates go down in 2015, sales go up right away. Rates go up, sales go down right away. Rates go down, the sales still go down as the rates are coming down. Shortly thereafter, within a matter of months, sales go up. And you can see they're going up by 30%, 40%, 40%, 2020, and then spiking to 150% increases in sales. So it's a really interesting pattern. And there's an expression that describes this well. Nobody wants to catch a falling knife. Right? You wait until it's on the floor and then you pick it up. Right? People are waiting for everyone else to get back into the market, and they'll do that once the rates settle and there's more certainty. That's the general population. The other really interesting thing here is that this chart is the same, but with pricing increases or decreases. So the blue is the only thing that changed, and really it's just about the scale. So now, instead of going up to 150%, we're talking about 30, 35% increases, but it's the exact same pattern. So as soon as sales go up, pricing goes up too. It doesn't take 6 months of high sales volumes in Toronto for pricing to go up. The second that there's more demand in the market, pricing starts to go up in Toronto. And we see the exact same pattern. Rates go down, pricing goes up. Rates go up, pricing goes down. Rates are currently coming down. They're expected to settle at 2%. The banks have been right so far. So once they come down to 2%, what's probably going to happen to sales and pricing? Well, according to a 20-year history and how the banks have been doing so far with their forecasts, sales and pricing are going to go up. That's without taking into account the housing shortage that we're going to run into, which is something unique to Toronto because of the way that we build housing in Toronto. And it creates an opportunity for savvy investors who can choose the right product that's going to occupy at the right time. And that's where Ryan comes in with his team. So the real estate market is soft, right? And it's like that basically all around the world right now except for Dubai. In every major market. But it's not just the real estate market. If you look at IPOs, initial public offerings, you can see the boom that happened when we had our low interest rate environment post-COVID, right? We had 1,000 IPOs. There was 480 in 2020. 2024, we only had 192 IPOs, 154 IPOs in 2023. So IPOs are down. Mergers and acquisitions and venture capital, tech companies buying other tech companies, down. Distributions are down, right? Big hospitality is down. Big retail is down, right? Businesses that need to take out loans or that took out loans and needed to renew that now have to do so with a high interest rate environment are all suffering, right? All right, let's talk about Mr. Carney and his housing plan. So, capping immigration. What's interesting is that he's talking about capping immigration, and the news articles are saying that this is a solution for the housing shortage and the housing crisis. But when you actually look at the numbers, he's capping them higher than the pre-COVID levels. He's capping them the same as the emergency wave of immigration that we let in at the tail end of COVID to help make up for COVID, to help make up for closing the doors. So he's capping them at a really high number. Doubling housing construction. Well, he's talking about, as a country, going from 250,000 homes to 500,000 homes per year. So the CMHC says that we need, so Canada Mortgage Housing Corporation says that we need 6 million new homes by 2030. So if the federal government is able to double housing construction, the federal government has never been good at building housing, let's face it, right? But let's say that they do, that would give us 2.5 million new homes. So nowhere close to what we would need for the 6 million new homes. He's also talking about starting Build Canada Homes, BCH, affordable housing on federal lands. And so you may have heard how they've been talking recently, they've been asked by reporters, do you plan on trying to bring down housing pricing? And the housing minister, who's from BC, says no. And Mark Carney danced around the question pretty well. They don't plan on bringing down housing prices because we have really high ownership rates of housing. It's over 60% of people in Toronto own homes, which is way higher than across the US. And if they were to bring down the housing pricing somehow, it would be very unpopular for all of the voters, right? No one would be happy. So, or a large majority of people would not be happy. So it seems like his plan instead focuses on creating new affordable housing for people that can't afford to get into the housing market or who are getting turned down from their rental applications because their credit is bad, they don't have enough income. And so when they talk about doubling the housing construction to 500,000 homes per year from 250, they're doing that through Build Canada Homes, which is affordable housing on federal lands, and it's public-private partnerships with the private sector development. So they're talking about $10 billion in low-cost financing for affordable housing, not for market-rate condos. So it's a completely, if you're looking at this as an investor, it's a completely different target audience. It's people that you wouldn't rent to normally. They wouldn't meet your qualification criteria. $25 billion in incentives for financing innovations like mass timber and prefabricated homes, so homes built in factories, for example. The MERB program, multi-unit residential building program, this is a tax incentive for builders to build new rental supply. So we're not talking about a similar competing category to low-rise housing, market rate low-rise housing, or condos. They're also talking about lowering development charges and the GST, which we've just seen come into place. Right? So this is no GST for first-time home buyers on new homes under $1 million, and then it scales up to 1.5 million. So if anyone's a first-time home buyer and has questions about this, they haven't written the regulation yet, but we do have a lot of information, a lot of details, and as long as it's essentially below 1 million, which all of our suites here are, and you're investing after May 27th, which it's now after May 27th, then you qualify. This works for you. You're checking the most important boxes from a qualification standpoint. In terms of the immigration numbers, 2019 we had 642,000 international students. In 2021 it was 617,000. In 2023 we had 1 million international students in the country. It was a lot of international students. And then the government policy was to reduce the number of international students, basically targeting colleges for the most part. And now we're talking about a cap that the federal government is putting in place. So this is for international students. Now let's look at temporary foreign workers, right? So this is for non-permanent residents. This is the cap that's being put in place by the new Canadian government. So for temporary non-foreign workers, it's hard to find numbers, but in 2021, we had 845,000 temporary foreign workers in the country. So altogether, between the peak seems to be just under 2 million between international students and temporary foreign workers in the country at any given time, just under 2 million. The new cap from the federal government is 5% of 41.5 million people, which is 2.1 million. So the new cap that's being put in place is actually higher than our peak numbers of temporary foreign workers. So they're not putting a cap in place that's going to reduce the levels of immigration that we've seen so far. So we're going to continue to be the fastest growing city in North America. And we talked about bank prime rate. Bond yields have been coming up a little bit recently, but if you look at the past year, they're still significantly down, and that's why you see 5-year fixed rate mortgages below 4% with some banks now, right? Maybe as low as 3.85. So the 5-year bond yields, that's what tracks, that's how the banks set their fixed rate mortgages, right? Whereas the variable rate mortgages float on bank prime rate at a high level. Tariffs. So Tiff Macklem on March 20th said that we had managed the soft landing, right, without putting the economy into a deep recession. Unfortunately, he says we're not going to be on the tarmac for very long. The economic impact could be severe. The uncertainty is already causing harm in the market. Canadians intend to pull back on their spending. Businesses have lowered sales outlooks, delaying or canceling investment projects, and they're scaling back on hiring. What's interesting is the Bank of Canada plays their cards really close to their chest. They're not making any sudden movements by not making rate announcements. But what they're saying is that the economy is hurting because of the uncertainty around the tariffs. And if the tariffs stay in place for the long run, what all the reports from the banks are saying is that the Bank of Canada will have to lower interest rates further. That's the effect of the tariffs. If they put a 25% tariff in place, it raises costs by 25%. But it's not because of all of our spending because of cheap loans, right? It's because of a one-time tax. So increasing interest rates is not going to help. In fact, because of that one-time tax, it's slowing down investment, slowing down consumer spending. Therefore, the rates may need to come down further. So the general high-level statement here from the Bank of Canada is we don't know what's going to happen with tariffs. Are they on? Are they off? Is there a deal being negotiated? Is it going to stay in place at a high level for very long? What they're saying is if we have high tariffs for a long period of time, it'll very badly hurt the economy. And the banks are saying, therefore, the rates will have to come really far down. But if they don't, we're probably going to have that 2% Bank of Canada scenario, 2.25. If the tariffs stay at a high rate for a long period of time, we're probably going to see it come down less than that, like we did during COVID or like we did during the 2008 financial crisis, right, where it was below a 2% Bank of Canada rate. And what we saw with those low interest rates, despite being in a once-in-a-century pandemic, or after the 2008 financial crisis, was that the real estate market ripped, right? So despite all of the uncertainty that we had, having to wear masks, do we get vaccines, how many, are we ever going to have normal lives again? The real estate market took off because the interest rates were low. So the number one factor here, all of the uncertainty, what about the wars happening here? What about the tariffs? The number one factor is really the interest rates in terms of demand. And by the way, the tariffs only add about 2 to 3% on the construction costs for condo projects because the concrete, the steel, the lumber, we have all of that locally. And so what comes from the US is usually just more the sophisticated mechanical parts that come up from the US. So it's a small increase on the overall construction budget, but worth getting in before then. So the fundamentals here of this outlook on the market are tremendous amount of population demand, low amount of housing supply, and interest rates being the major factor, right? So the reason why Sevoy chose to launch 1515 Pickering Parkway is because Durham is the fastest growing region in the GTA, faster growing than Peel, Halton, Toronto, York. And housing supply is essentially flat in Durham. So while population growth is going up, housing supply is flat. Which is why we saw 31% price appreciation since 2020 and 6% annual rent growth from 2018 to 2023. Here's some more updated numbers on condo pricing that you can see. This is essentially the same as the summary here. Resale for all buildings, total growth is 27%. The rent growth in Pickering. Now, in terms of Durham, Pickering is the AAA location. It's the closest to Toronto. It's on the border of Scarborough, right? We have the waterfront, we have a great mall, we have transit. And Pickering has been identified as an urban growth center by the province. And there's urban growth centers throughout the GTA. For example, downtown Mississauga or downtown Vaughan. Now, downtown Mississauga has been booming for 20 years, right, with high-rises. And you have the mall there, but you don't have the transit yet. They've been working on the LRT for like 15 years. So no transit there, but we do have a beautiful mall. Vaughan was essentially a blank slate. All it really had was the subway. It didn't have the retail. It didn't have the mall. And Vaughan started within the past 10 years. The newest urban growth center is Pickering to start emerging. So we've got the mall, we've got the transit. Pickering also has some of the highest household incomes. Second to Vaughan, higher than Markham, Richmond Hill, Mississauga, and Toronto. This is a screenshot from the Places to Grow Act. So this is the legislation that was put in place. Some of you may be familiar with the Greenbelt, right? That was put in place in 2005. There's the Places to Grow Act as well and the provincial policy statement. So this was all the legislation that essentially turned us into the high-rise city that we are. So it really the balance started to shift in 2005. Because in 2005, it was 70 to 80% low-rise housing, 20 to 30% high-rise housing. After all of this legislation came into place, this law that was put in place by the province, it's the reverse. Now we're 70 to 80% high-rise, 20 to 30% low-rise. So this is literally a screenshot. All I did was put the logo in the middle here of the Urban Growth Center. Okay, so we're right in the middle. And this is where the city wants all of the high-density growth. So this is in 2014. They hired this firm to help them model where the high-rises were going to be. And this was a workshop that they did at the city, and the scale model that you see here has blue towers showing where the future high-rise sites were going to be. So this is essentially what the urban growth center looks like now, minus the high-rises that you see right across the mall there. There's a few towers there. That's these ones right here, right? This is the GO train station. This is the bridge, right? We're a 5-minute walk from the bridge. This is the mall. This is City Hall right here. There's parks. There's the waterfront. This is Toronto. That's the border right there. Okay. This is Frenchman's Bay. This condo project here is called San Francisco by the Bay. Some of the more recently completed condos in Pickering. And we'll use those as a comp when we look at the total investment amounts. So this is essentially what it looks like now. This is what's under development now, with a lot more to come. And this is a number of high-rise developers, and this is our building here, 1515 Pickering Parkway, right in the middle. One of the interesting things is that all of these are multi-phase projects, except for ours, we're a single tower. And a lot of investors look at multi-phase projects because phase 2, phase 3, phase 4 brings more people, adds more value, brings more retail. It's an investment strategy to buy early on in multi-phase projects as the area gets built up. The downside with that is that phase 2 might be right in front of your unit, and phase 3 and phase 4 might just block you in completely, and you're in a construction zone for the next 10 years. So that's the downside of that. That's sort of the beauty of us here, because we're within a 5-minute walk to all of these multi-phase projects, but we don't have a second, third, fourth phase that's going to block our views. we have unobstructed views for the long run. The great buffer to the south, clear views of the lake. So that's nice, because whether you're moving in yourself, it's an investment personally, or it's just an investment in general, unobstructed views for the long run are great. Chestnut Hill is here, Tribute is here, Center Court is here, and there's many more high-rise sites that don't have developers on them yet. If you're familiar with Pickering or you're driving around, you'll notice a lot of the big retail plazas have planning applications for lots of towers. So Pickering is going to boom in terms of high-rise development. And we're right in the middle with a prime location here. The GO trains, by the way, I mean, the entire GO train network around the GTA is electrifying, so the trains will be quieter and faster. They'll accelerate quicker. The current GO train on average goes at about 90 kilometers an hour. They are going to be increasing in speed by 50%, up to 140 kilometers an hour on average. So they're going to be faster. And maybe the biggest and most important factor is, instead of waiting for the train for an hour and timing when you're going to show up at the station, the trains will come for every 5 to 15 minutes. There'll be trains. This station has one of the quickest times, with a new train every 5 minutes. In that case, you just show up. You don't need to time it. You jump on. You've got Wi-Fi. It's clean. It's safe. It's quick. You can use your cell phone. So to be within a 5-minute walk of that is great. And the lines are currently being electrified. It's underway. This is a large tower, 571 apartments, 40 stories. And I mentioned the Frenchman's Bay and the condos that were built at Frenchman's Bay. If you look at those investment amounts, what those trades are going for on the secondhand market right now, what you'll see at 1515 Pickering Parkway is that you can actually own for the same, slightly less, or slightly more than the secondhand resale market. This is a big deal, because then you're not speculating. Let's say that this building is built tomorrow. The appraisal comes in right on, because the appraiser is going to go over there. They're going to say this is what a one-bedroom trades at. Now, just FYI, these one-bedrooms are 500 square feet, maybe 510 square feet. Ours are like 480, 485 square feet, slightly smaller, but great layouts. So it's not really a noticeable difference, maybe 20, 30 square feet smaller. These ones don't include parking, neither do ours. So it's fairly comparable, I think. Generally, we're a little bit smaller than those ones are, but this is a really unique circumstance. Normally, with pre-construction investing, you're investing more than the secondhand market, and what's happened historically is that the secondhand market is appreciated by, well, now, because of the more recent flat market that we've had, now it's been appreciating at 6%. Before, it was 8, 9, 10% on average, if you take like a 20-year look at the market. But typically what happens is the secondhand market catches up and then exceeds what people invested at pre-construction, even if you invested at 20% higher than the secondhand market. Here, you're investing basically at the secondhand market, so you're taking speculation out of the equation. So that's very special. There's some listings. We have an incredible deposit structure as well, which is nice. So that's your investment structure spread out over time, right? We also have a 2-year rental guarantee with 2-year free maintenance fees and 2 years free rental management as well. And this is interesting. So this is if you want to rent it out. We'll actually guarantee the rents for you. And even if there's no tenant in the apartment, you still get the rent. Now, we're obviously offering this incentive because we believe that it's going to be easily tenanted at high rental rates, and the rents will continue to grow. So, but it's something that people like to take advantage of. And what you'll see is that also it cash flows. Great amenities, large gym. There's an off-leash dog area at the back that's fenced in. There's park space, 24-hour concierge, state-of-the-art finishes. So here's a sample one-bedroom. So one bedroom at $467,000, and the rent is $2,400 per month. That's the rental guarantee amount for 2 years. So let's say we occupy in 2029, right? It's guaranteed for 2029 and 2030. So the apartment isn't actually exposed to the rental market until 2031. That's a really long time horizon that you get as an investor, right? We're doing free maintenance fees, right? Here's the mortgage rate at 3.5%, right? The current 5-year mortgages are as low with Desjardins, for example, 3.85, right? So this is a reasonable estimate. Taxes, so you're cash flowing at just under $500 per month, and you're paying down your principal, paying down the mortgage, or the tenant is paying down the mortgage for you by $650 per month. So that's like $1,100 per month in value that you're building every month. And yearly, over $13,000. So now you have a cash flow positive pre-construction investment. So you're pairing pre-construction with the deposit structure and the time that you get with essentially the same, very close to the secondhand market, so you're not speculating on pricing, and you're cash flow positive for 2 years. If you ever looked at cash flow positive investments, you're looking at like multiplexes, right? Like you're looking at like a sixplex, you're going to Windsor, you're looking at student housing that you're cramming in a bunch of rooms into. So this is a really unique opportunity to have this trifecta of qualities from an investment opportunity. So here's the 1+10s. I'll skip over these quickly. Ryan and his team can go through the numbers and details with you. The 2 bedrooms. And that's it.
Thank you.
You like it? You good?
Yeah, it was great. Guys, I love the numbers. This is what gets me excited, and hopefully that helped anyone who, you know, is nervous about the future of the market, wants to understand it better. For me, looking at the past data and understanding what's happening on a government level, on a city, municipal, provincial level, is very, very important. So yeah, that was awesome. Thank you very much.
Thank you
guys,
so much.
stick around. My team, just put up your hand. If you guys have any questions about the market or about this opportunity, please come up to us. We got some packages so we could share the pricing. I've been very fortunate to work with RDS and this developer for years. I've got a very exclusive price discount. I won't say because I'm being recorded, but come talk to my team. We're able to do something really special in and above the incentives that they're currently offering us. So
that's right.
Thank you everyone for coming. Appreciate it.
Thanks so much. Please stick around. We're going to answer any questions you have.